And hello, everyone. Welcome to the Real Estate Show on KCMX News Media 880. Pete Belcaster and Joe Brett, the real estate guys, with you today. This final weekend of July, smoky weekend that it is, and hot weekend and dry weekend as well. All those things we can put into the equation, I think, for this weekend. But please stay safe. More than anything else, and stay cool. You know, that's the big thing.
Stay out of hazy, smoggy air.
Smoke.
Worse air than Beijing.
Well, you know, whenever we do real estate transactions, you have to have a real estate broker, and you generally have to have a lender unless you're paying cash. And we know that about 30% of sales are cash sales. We hear a lot of Californians coming up with cash, things like that. But for the most of us, we got to have a person like these two guys with us today to help us get through the thing that we're talking about, lending. Guy Giles is here from Bank 34 Mortgage. He's our resident mortgage expert here on the Real Estate Show, and Guy's been with us a long time. First of all, how are you doing here this time of the year? Tell us what business has been like for you.
Well, I had a couple of weeks where it was a little slower, and then about a week and a half ago it went crazy again. So
really,
we are just I'm 12 hours a day and 6-7 days a week right now.
Really?
We're pretty blessed.
Well, what are you doing? What are you loaning at? Tell us what's going on.
It is a mix from people buying from out of town. I actually have a lot of first-time home buyers right now.
Okay.
We have some pretty cool programs. I mean, there's obviously the Home Ready and some things out there that are a little bit lower down payments, some subsidized mortgage insurance. We're not really doing the old USDAs anymore. They're kind of down the road.
Isn't that something? When was the last time you did a USDA loan? In fact,
I did a pre-qual about 3 months ago, but I haven't actually closed one in about 2.5 years, 3 years.
What's the cause of that?
Well, just the restrictions. They're so tight on their debt-to-income ratios. It is kind of the lowest, defaulting loan.
Right.
Mm-hmm.
So, in that respect, you got to kind of like what they're doing there. But it's just with our prices where they are right now and with the rates going up, if you can qualify, there's not a house out there.
If you but just go back to USDA for a second, because USDA loans saved the real estate market when the crash hit. I mean, if it wasn't for remember USDA loans in Klamath County and Douglas, Josephine
really
County,
well.
that's all they were doing. And you're saying now, even with 0% down in that type of program that's out there, it's just kind of filtered away in this market.
It has.
That's amazing.
And well, believe it or not, with the income limits and their low debt to income ratios that they'll accept, it's just people don't really fit into that bucket. And generally, if you can get a little bit of a gift or something from a family member, and we can give you 3% down. Actually, I now have a grant program where I can go with 1% down,
right.
And so there's some lower down payment ones, but if you can come in with at least 3 or 5%, you don't have to carry that mortgage insurance forever, and that's a big deal in a raising rate environment. So
tell us about FHA loans right now. You don't even do those hardly anymore, do you?
Believe it or not, we do some of them, but with our credit scenarios, if I can work with somebody to try to put them into a conventional loan, I will. I'm not the kind of guy that wants to stick you into a loan for 2 years and promise you that you can refinance out, because by the time rates go up, we get, heaven forbid, a little bit of a inverted yield curve like I think is coming, and we get a little bit of a recession or a little bit of pullback. You might not have as much equity as you thought you might have at that point, or you just don't want to keep that mortgage insurance forever.
Joe, look at this. What Guy is saying, that the two government main loan programs, really, USDA and FHA, have kind of gone by the wayside. They haven't updated or changed them, and so they're just falling by the wayside. that's a good way to describe that.
And
because
the
of the
FHA with that mortgage insurance, that's a lot of money over the term of a 30-year note.
And they definitely played a dirty trick on the new administration is here right now. They got rid of that funding fee forever the day before this new administration took office, knowing that they couldn't keep it like that, and then they blamed him for getting rid of it. And so politics aside.
All right. So anyways, it gives us a good segue, Guy, into your guest, who is Phillip Aust, who's a wholesale account executive with Washington Federal. Now, I've been around him a while, and I've never heard of what a wholesale account executive is in the loan business. So first of all, welcome to the show. It's nice to have you here. You're out of Portland, right? Out of the Washington Federal in Portland?
That's correct.
So what is a wholesale executive, Phil? Tell us what that is.
So really my job is to educate our brokers in this market on our loan products and facilitate the file once it gets to us.
Mm-hmm. So when you say facilitate, what does that mean? Facilitate the loan programs.
So when Guy will take an application, he will submit it to us through our porthole, and we will work together to gather the information, disclose, and get credit approval.
So that would be like, okay, tell me this. If I understand the business, your business a little bit, right? I come to you first, and then you would go to seek someone out like Washington Federal or other loan. Is that how that works, or what?
Yeah, I mean, basically, we do most things right in-house ourselves. I don't broker a ton of loans, but he just happens to have some really good programs. So in some instances, what I'll do, if it's a program that I don't have, or it's not, kind of a more mainstream one, we align ourselves with just a couple of really good guys that we can broker to. So he has a couple loan programs. What I'll do is you'll come in and meet with me. You'll really even never know that they're involved until you make your first payment. So it's one of those things. You'll come in, you'll see me. I'll collect all your conditions. I know kind of what it is you need. I will get it over to him. If I'm missing something, a bank statement or a pay stub or something that we need for the loan, we'll work on that together, figure out what we need, and then I'll get it turned into him, and he'll, they'll facilitate that back at their office.
But you're really the gatekeeper, right? I mean, you're the initial gatekeeper of all these kinds of loans or all these kinds of products that are out there, right? I mean, they come through you first.
Yes, you come see me, and then thankfully we got guys like him that are really knowledgeable about the products, because it's one of those things that I do quite a bit, and I'm familiar with them, but I don't know all the ins and outs. So sometimes he can help me move something along that might get a little stuck. And
so you pick and choose as the main lender the type of different loans that are out there that's going to fit that individual, correct?
Yeah, and just a real live one from today. I have a lady that has been trying to sell her house. She's buying a brand new Hayden home, and this home is going to be done now in about a month and a half. And she was planning on having her house sold before this loan got done. So I approved her using one of these programs that if her house didn't sell, and right now she's not in escrow, so she's going to need to get a loan. So what we'll do, and he can explain the ins and the outs of the program, but basically we're going to do a loan on her old house, and it's kind of like the old bridge loan, and we will enable her to only have the one payment, and she'll be able to get into her new house. And probably you should go into the, I didn't want to bring you in here and then say everything, but literally, she's able to get into the house, and then when her house sells.
So you're okay. If I hear what you were saying, okay, you're talking about now we have a lot of contingent offers, right? I mean, we have multiple offers here. I mean, our market is not quite like Portland, but certainly it's busy. So you're talking about...
That's actually the most... I don't mean to cut you off. That's actually the most important thing about this. You're literally writing a non-contingent offer at that point.
That's what I'm saying. So what I'm hearing you say is that you have a way to be able to write a non-contingent offer, because right now, when I go to our office meetings, we hear this all the time. I mean, I have to write contingent. It's contingent upon this. I can't find anything, and people are losing deals because the contingency runs out.
Okay, it's a competitive market.
Okay,
definitely.
Tell me how that works then, Philip. How does that work then? Again?
So we're utilizing the equity in their current home to either purchase or construct a new home.
The equity in the current home.
That's correct.
Okay, continue on. All right, Okay, go ahead.
So by utilizing that, whether you have a mortgage or not, whether the home is paid off or not, we can utilize that equity, and by originating a new loan against both properties.
You originate a loan against both properties.
That's correct.
And the other, okay, all right, continue on.
Okay, so when we're looking at that, we're looking at about 75% combined loan to value up to $1 million, and 70 up to $1.5 million. So quick calculations, let's just say you have a purchase price of $600,000, and you've got a let's just say $500,000 valuation of your current home.
Okay.
And you would multiply that figure. That'd be what, 110. You multiply that by 0.75. You're looking at $825,000, and then you would subtract whatever. Let's just say they have $200,000 in mortgage or first, second, whatever that may be.
Okay.
So you're up to what, $625,000 would be your max loan amount on that. Now we're able to lend up to 100% of that $600,000 plus closing costs.
Wow.
We're not going to give any cash back.
Right. Okay. Yeah. It's okay. Yeah. Oh, that's pretty. So are people taking advantage of this? I mean, it's pretty interesting thing.
It's probably our most popular, other than our custom construction.
Yeah, and that's going to be kind of a sign of the times.
Think about that
as well. It kind of that's a program that meets the needs and meets the conditions of the market.
Absolutely. I'd like to do that if you're selling. It is a true all-in-one construction loan that we're doing here too, And I mean, if you're just going to go build a house, I mean, that takes a lot of pressure off as far as having to sell the house right now and then make those things kind of come together, especially with, builders as busy as they are and materials not readily available. I mean, you don't know exactly when that house is going to finish being built or permitting,
And what a mess having to move again, find storage.
I'm just thinking that there are so many people who have written and have experiences, our viewers and clients, about contingent offers, and that's what we've been talking about on our show for quite some time. So this is actually a way of doing this. But what's the kind of the minimum equity you have to have in the house? Because you can't do this if you owe a lot on it. So is there a minimum on that? Is it
25%?
So you have to have 25% equity into it.
Yes, correct.
That's not that.
That's reasonable.
That's not that bad.
And it's another thing. It's like how this gal came to me that I'm going to be doing this program on tomorrow morning. We thought her house would be sold. So if you have people out there that are, that might be in that situation, I can get them pre-approved. You can still make your offer. It's no harm, no foul if the house gets sold before and you don't end up needing me. I mean, I don't mind spending a little bit of time, vetting these people out to make sure they're ready to go. But at least you can get your offer, get it done. And like I said, if the house sells before, we'll shake hands and everything's okay.
Now, what was the name of this loan again? I just want to make sure I got to get it right. What was
Sure, it's a cross-collateral.
Cross-collateral loan.
Correct.
Which is basically a non-contingent. You can make an offer without selling your house first. I've had clients where we have been able to get a loan without selling their house, but then you have to have, you got a lot of equity and money, kind of things to do that. But this does not require that. 25% equity, roughly, and you can do it either moving, right sizing up or right sizing down, right? It doesn't matter where that goes.
And another thing about it is there's the old school bridge loans. We had time frames in which to sell that home.
Right, I was going to ask you that.
We don't have any time frames to sell
because they don't have to be under 90 days to sell the other house because they've already got the loan on the new place, and the other house is taken care of as part of that.
Correct. So so it's a single loan, but let's just say without having to pay back to sell that home, that opens up opportunities for you.
I don't have to sell it, maybe.
You don't have to sell it.
I could rent it.
Wow.
I mean, it's set up to be sold.
Goodness.
I mean, that's how the program is set up. It's meant to be sold. But as long as we are comfortable with, the current market, the marketability of the home, maybe you've got 3 months liquid assets for PITI on both homes, then we feel comfortable in our security interest that we can move forward looking at what we call a post-sale debt-to-income ratios. Okay. So let's say you have a...
You got to hurry up. We've got a break coming up here, but
we'll talk about it more.
But I love that thing. That is a fascinating cross-collateral loan. It's fascinating.
And there are people out there that could really learn to hear about it.
I can think a lot of people just right off my head. I'm thinking this might work for you. So anyway, the Real Estate Show today, we're with Phil Aust and Guy Giles from Bank 34 Mortgage. We're coming right back. The Real Estate Show continues after this. And welcome back to the Real Estate Show on KCMX News Media 880. Pete Pelcaster and Joe Brett, the Real Estate Guys, with you today here in last weekend of July. Smoky, hot as it is, and hope you're safe and have a good weekend, right? And good week. Real estate sales, by the way, last week we were talking about sales. They were really down a ways, There were only 70 closings last week in Jackson County, which is down. And we talk about, the reason we can say this is that we know how many lock boxes are open. And I just wanted to show you one. Can I show you one thing here? Let me just do this. And what this is that you can see this figure is the number of lock boxes, which is the number of agents open boxes, the homes. And this one here shows June of this year, and you can see it's over 10,000. I'll bet you when we look at July's, it's going to be down because since the smoke has come in here the last couple of weeks, agents have all been saying that we're just seeing fewer openings, fewer people coming. They've canceled things like that, so it's going to affect the market. But what's going to happen when the smoke clears? There's going to be a big backlog of buyers, and people are going to come back in here, and they're going to want to be here for sure. Today on the Real Estate Show, we're talking with Guy Giles, who's our mortgage expert from Bank 34 Mortgage here, who says he's busier than heck.
Yeah.
Yeah?
Yeah, I don't even know what to say. So I think I've done, 12 in the last 6 or 7 days.
My goodness. Yeah, and are you still, I know you do a lot of VA loans. Are you still doing a lot of VA loans and stuff like that?
I never really set out to specialize in them, but I do tend to do a lot of them. And probably 3 or 4 of these are VA loans that I took. So.
Well, you do a lot. And I think I can't wait till my son gets up here to do our VA loan with you because we're buying a ranch, some sort of property. Can I do that with a VA loan?
Yes.
I can I?
Yeah. I mean, it's got to be, residential in nature.
Yeah,
so,
a house on it, right?
Yeah.
It can have a house on it.
Yes.
Can it have a barn?
It can have a barn. Yeah,
See?
just not peeling paint on that barn, though.
You
so just got to be a little careful.
See, that's what I'm doing now. That's what I'm
well, welcome to Pete's shopping for his son's new place show. Mark, we got you all lined up.
We're taking care of him. I tell him that thing all the time. He watches us too. So anyway, we do that. Anyway, so I'm good to hear that loan that your loan really good. I'm just it amazes me when I hear you say that.
And there's actually just let me dispel a couple things with the VA loans. There's a lot of people that stay away from them as real estate agents. They think that they're really hard to do. Yeah, they don't like peeling paint, but one of the really nice things about it is the appraisals have to be back in 10 business days. So I mean, literally, you have to have that on your 10 or 15. Gosh, they come back so fast. Anyway, at the end of the day, they get done quicker, and we really don't get beat up. I mean, if it's just your regular house, they're closing all day long. They allow a little bit higher debt to income ratios, and then what's better than helping a veteran get into a house?
Absolutely.
And what are rates like this week? I mean, tell us where they're hanging around.
Well, they've been flat lately. I mean,
they
it's
haven't
one of
gone
those
up.
things.
They've been, yeah.
No, they went up. We got a little bit of a spike. Looks like some of the stuff with the EU, they've come to some understandings as far as some trade things, which part of the negotiations, I guess. So the market's reacted pretty strong to that on Monday, but we've bounced back from that a little bit, and the rates are honestly, depending on your credit, mid-high 4s to low 5s if your credit's horrible. So it just depends.
Yeah, Phillip, do you see these rates changing? I mean, you're kind of up there in the big bank up there with Washington Federal. Do you tell us what you're seeing the rates going with?
As a portfolio lender, we look at rates a little bit different. So when we're at historic lows, we're not chasing those rates in that paper because we maintain our paper. We don't sell in the secondary market.
They don't at all?
Not at all.
Really? Washington Federal does not do that?
Yeah.
Huh.
And so that gives us some leeway with our rates. But we're currently 4.5 up to 700,000. We don't have a conforming loan limit, so when you're talking jumbos, we're able to go up to 700 at 4.5.
All right, now let's talk jumbo loans for just a second here, because as our listeners and viewers know, Joe, the luxury market is kind of fallen. I mean, there's like 2-year supply plus right now. There's over 50, and very few go pending. Right. If you look around at it, thing. So to buy something like that, tell folks how the jumbo loan works and what would work in something in the luxury home around, or when I would want to use a jumbo loan.
Well, we raised it up a little over $450,000 this year, so it's just basically what it is the government, what they'll allow Fannie Mae and Freddie Mac to buy. And again, these guys aren't necessarily bound to that, and I can broker, I can do my stuff right to them, which is kind of cool. But basically, it's just where the secondary, the portfolio lenders kind of step in, anything above that. So if you have, a decent down payment and a decent credit score, actually the jumbo loans can be really competitive right now, because they know that that's just a different, kind of a different buyer. It's not their first time, and they know that they're probably going to pay their bills.
When is somebody going to use one? When would they want to use a jumbo loan?
Anytime your loan amount is over that $450,000.
Is over $450,000.
Yeah.
So if I have a $800,000 place I want to buy, something like that.
If you don't have $350 down, then you're going to be into that world.
Okay, so how that works then? How does that work then at that point?
A loan application.
Well, I know that, but
it'll feel a lot.
Okay,
yeah.
I've got $800,000, and I got
it'll feel
$80,000 down or something, and I'm not there. So
it's just a lot like a regular loan. We're still going to be on a full doc situation.
Does it go 30 years? A jumbo loan go? 30
years? You can pick different times as far as those go, but I mean it's pretty much the same thing. It's just a little bit different guidelines.
Does it increase my cost as the borrower on that kind of a property?
We don't charge any more for that. I mean,
it doesn't?
They really figure that they're going to get more in interest, on the money, and their goal is to loan out as much money as possible. It takes just as much work.
Sure.
And it takes just as much work to do a $800,000 loan as it does to do a $100,000 loan, and and they're going to make a whole lot more interest on an $800,000 loan. So, you know, we have some doctors programs and some different things also that have lower down payments, and, you know, anyway, there's a lot of options once you get up into the jumbo land.
Are you seeing, I mean, in your portfolio that you're doing right now, are you seeing, do you have a lot of luxury homes in there that you're loaning on?
I only have
like that?
Like one in my pipeline right now.
Yeah, see, they're just they're not there.
You know, and a lot of my business comes from California though, and yeah, these guys have a lot of money, but either they're cash or they do walk in with a pretty large down payment. So even though a lot of my purchase prices are $600,000, $700,000, you know, a lot of times I'm only doing a $350,000 loan on it or something. So, you know.
And Phillip, Washington Federal, that kind of caught my ear that you don't sell loans to the secondary market. What's the that's different from a lot of banking and institutions' approach to it. What's the game plan there of why Washington Federal does it that way?
Well, the game plan, I mean, that's a good question. You saw what happens when our let's say, common sense underwriting. You know, does it make sense for the borrower? Priority number one is it a good loan for the borrower?
Right.
And we've seen what happens when that is not a priority.
Yeah.
Okay?
Yeah. Oh, yeah, we saw that.
Number two, is it a good investment for Washington Federal? You know, those two things are important. Obviously, we want to make our money as well. But by not being held to those same guidelines of Fannie and Freddie, we're able to, like I said, work with Guy and offer a lot of products that Fannie and Freddie just can't, or offer rates that Fannie and Freddie just can't.
Right. Every now and then we see this stuff where something completely makes sense, but it just doesn't fit into Fannie Mae and Freddie Mac's guidelines, and it's, you know, it's a big ship to turn when you're trying to change a guideline. Even if something makes sense, you know, these guys can step in, and, you know, it could be something that's pretty easily explainable.
We don't check boxes. We actually underwrite. You know.
Yeah. Right. Well, it sounds like much more flexible. And being able to change product mixes or something much quicker than the government loans can do, as we've seen earlier with USDAs and FHAs and stuff like that.
And what a good tool in your toolbox, Guy, to have that option and have that connection and to serve your clients.
Yeah, that's why I was super blessed that he was going to be down here today. So I just... Poor guy, I don't even think, where did I tell you we were going to coffee or something?
Yeah. And now we're on the radio.
Yeah. and he ends up here with us. Well, you know, that's probably okay. Okay, where are you going from here? Rates, I suppose, as we go. What other products? You got cross collateral we talked about, which is the this is fascinating to me, is the non-contingent loan. And seriously, if you fall into that case, you should go see Guy, because that would be something
and like
that
I said,
think,
even if you think your house is going to get sold, come in and see me. We can at least get your letter out so you can make that offer, and then, you know, like I said, no harm, no foul. You know, you're not.
You almost have 25% equity in your house. You know, you could do that.
Yeah, but I'm tied by other factors in my contract.
I'm just saying, I know, but still, but 25%. I mean,
don't think I'm not listening. Yeah.
Well, a lot of people could do that. I think I'm fascinated by that.
And a lot of people, like myself, just got that 25% equity in the last 3 years. I mean, it was non-existent. It was not something that you could call on or parlay into a cross-collateral loan or anything.
Yeah,
and a lot of us didn't have it.
And just do keep in mind that it goes a little bit beyond just the 25%. You know, that's the minimum for that, but it is. You know, you have to have like 30% equity, but between both properties. So we'll look at, you know, both of them and then come up with a formula there. But it's pretty flexible.
Yeah, well, it sounds like it, and you have to be in that thing. I mean, the worst thing you can do is be with your seller, and you get an offer come in, and it's contingent on a sale of another property, maybe in another state, in another place, or even across the street. It just turns the seller off.
Or the other worst thing would be. Would be if you got stuck and say, you know, something happens and the smoke stayed in here for another month and a half and your house didn't sell. Now you're not getting stuck with two full payments like you would be doing it normally. Even if you can qualify for both, this kind of gives you a lot more leeway to.
Well, it gives you some flexibility, and that's what I think we always want. You know, we're talking about being a smart real estate consumer, and the flexibility is what is intriguing here. I mean, it really opens up things, because you're not going to be in a strong. You go make your offer contingent on your house selling, and you know, you're in a weak position, and you have a couple of offers come in ahead of you. Your contingent offer is just going to be put to the back.
I'm finding out.
It really is.
I'm actually having it happen on the other side, where I'm getting into contract with people, and those people that are selling, my people are buying their house. Okay. That's contingent on them finding a house. So
we should talk about
it's the reverse. The ugly cycle.
It's the reverse, because sellers can't find replacement housing. We certainly see that with older clients trying to downsize and go into places. We see it all over. Yeah, it reverses too. You're absolutely right, and we don't talk about that. Yeah, you want to make an offer, right? You can't have it until I get I sell.
Till I get
another
settled.
place.
If you have a seller that's reluctant, you can come see me too.
Yeah,
Yeah,
is that right?
yeah.
So it works both ways.
Yeah.
That's an interesting thing. You're going to probably do really well with that. Just because, I mean,
help a lot of people.
it can help a lot of
potentially,
people who are in this situation in a market like this that is just, churning out and competitive in certain price ranges. Not everyone. I mean, not all price ranges, but certainly below 500,000. Those ranges.
If I'm a
really
buyer
big.
and I'm contingent and a cash offer comes in, I know I'm getting kicked right to the curb, and I don't have a chance. And so you got to strengthen your position. I think is the bottom line.
We got another break coming up here. But what are you seeing for pricing right now, Guy? We're kind of seeing the pricing kind of slowing down a little bit here, which is really good. I think that's important. But
well, if you look at averages, the West, I brought some statistics here, and it was 6.4% is for the U.S. just in general. If you average everything out,
you're
and here
talking
on the West,
rise in value kind of thing.
Yeah.
Okay.
In the
6%
last
nationally.
Yes.
6%.
Yeah, 6.4, and we were over 6% right here. Some of the places that did the best were the mountain region, where it was like 9.1. But these are real numbers from all over the country. I think where it's supposed to hit for the next 5 or 10 years is probably around 4.3 to 4.6%. So
that would really be a good, healthy increase. What scares us is that we go to the 9% as we saw some in Josephine County and other places. And again, when we talk about these things, it's not uniform all over the region.
No.
It's different areas.
Micro markets.
I mean, Ashland went down, if you can believe that, over the year. How's that crazy?
Well, it's one of those things. My last house that I still have it as a rental now in East Medford. I had it for 18 years. Even through the big crash, it still, I just did all the math on it, averaged about 4.3%, even through the huge crash of 09.
Yeah.
So, I mean, it's just a good thing to do.
Well, we've got one more break coming up here today. We're talking with Guy Giles from Bank 34 Mortgage and Phillip Aust, who's a wholesale account executive from Washington Federal. We're learning a lot about some interesting loans. We're going to take a final break, come back. The Real Estate Show continues after this. And welcome back to the Real Estate Show on KCMX News Media 880. Pete and Joe, the Real Estate Guys, with you here. Thanks for joining us on KCMX. Don't forget, you can check out any of our past shows at realestateshoworegon.com. All of our past shows are there, and we've had some terrific shows like today. We're learning a lot about mortgage and some interesting loan programs today. We've got everything back there from estate planning to the new tax laws in real estate to commercial real estate activity. Frank Mania was from Tycor Titles with us last week, and we got an earful about what's going on.
We've covered mold remediation.
We got it all. I mean, you name it.
Cover some bases.
Check them out, realestateshoworegon.com. Today, Guy Giles, Bank 34 Mortgage, is here, and Phillip Aust, who's a wholesale account executive from Washington Federal. Now, Washington Federal, people, they bought South Valley Bank, which was the Klamath-based group from the Wind family, of Gerald Wind. Washington Federal, that's been a couple of years. Boy, it's like you guys. It's been probably 3 or 4 or 5 years now. That probably happened. Yeah. Anyway, so that's how Washington Federal really came into our region, because they weren't here before. So anyway, so Philip's been working with them, and you work with Guy and all that. You had a loan before we get to. We're going to run out of time, but you also have a custom construction loan, right? Is this what you guys were talking about? Because new construction overall in the country, you think it's up. It is, but it's not that much. Anyway, what is that loan?
Well, it's just basically it's an all-in-one construction loan. So in the old days, or a lot of the loans, they have what's called a takeout. So you'd have to go do your construction loan. You'd maybe pay an interest-only payment, which was nice while you were doing that construction loan. You get it all done, and then you'd have to go and you'd have to refinance and do a whole other loan a second time, not really knowing where the rates are going to be 6-8 months from now when that house is built. So you can come in, we can do a construction loan. I facilitate it through him, and anyway, basically you can lock it in for 90 days at no extra charge, and get into a house. It's just kind of nice not to have to worry about a roof or air conditioner going out or any of that stuff. I've never had a new house until this last year, and it's kind of a nice thing.
That's right, you did, didn't you?
Yeah, and I was so paranoid about living in an old house for so many years. I put in a generator, and it never got turned on once.
You did. And you like your new house?
It's nice. You know, I don't get the big swings at the heat and the cold. And like I said, you know, I'm still replacing roofs and doing heating because I'm renting that old house out that I had.
But what you're saying is the result of the new construction laws that have made homes, is what you're saying.
Yeah,
built pretty darn well today. I mean, you know, to those standards of the old those original environmental standards. Remember your gold, silver, bronze levels, you know, of construction kinds of things. That's what you're at right now.
They're building some nice ones, and even, you know, I mean, just anything newer. Like I said, you just walk in there and you can just kind of feel the comfort when it's really cold outside or really hot outside. So
tell me what Washington Federal does on, or what you guys could do on terms of people wanting to build multi-units. We have a housing crisis here. I mean, I don't know Portland, Phillip, but I mean, we're in a mess here, and people talk about we have abilities now in our communities. Ashland, for example, and I think even Medford now, to infill and to allow people to use additional dwelling units to build all sorts of them. Would you guys loan on something like that, additional dwelling units? Tell people how they can go about getting that, because that's going to be the future. And I'll bet you guys are going to get more loans on those things than you can imagine coming up in the future.
Sure. So our custom construction also incorporates major remodel. So major remodel can also include or incorporate an additional dwelling unit.
Separate unit?
Separate or attached. Now, one thing I think that people or consumers need to understand is when you have a detached additional dwelling unit, the overall cost usually is more expensive than the actual valuation on it. So that's something to keep in mind when you're having a detached dwelling unit.
Well, I would agree with you, yes, but we can turn them into vacation rentals here in certain places that
it's
are
a good investment.
If you put money into them, you're going to get a good investment there. You don't matter about that on the loan then.
I mean, yes, since we're not, you know, it's still going to be an owner-occupied house at that point. You know, we're not really worried too much about, you know, if they're going to rent that out for a VBRO. We can't use VBRO income for qualifying on anything like that. But as far as using it for that, if you can qualify without it, you're good.
But if you have to put that extra money in above the valuation to get it in there, it'll pay you back.
Yeah, and by the way, that is something that is coming down the road. The VBRO income, Fannie Mae, they're testing it with a couple of people.
Oh, they should test that out.
It's something that is coming.
It's real money.
So.
Yeah. Well, we'll see where that goes. I think that is a huge opportunity for people. Now, in Ashland, okay, let me ask you this. In Ashland, for example, we're going to have coming on the market for the first time one of the tiny lots, Joe, with a house that is attached to another house with its own separate lot to be sold, about 300 square feet of house with a very tiny lot on an existing lot already that has been divided. You think you're going to be able to loan on those types of things? Do you see that in the future?
From my traditional guidelines,
it's never been done before. It's never been done before here.
Something you guys would look at? I mean, I would assume if the collateral is there.
You know, there's always possibility, but you know, we're looking at a difficult scenario because of comps. You know, appraisal comps.
It's just not going to be loaning in the future just on 3-2 new houses. You're going to see tiny houses. You're going to see additional dwelling units. It's changing every day.
And the beauty of being a portfolio lender is we have the ability to
change with it quickly. That's what I'm hearing from you today. Really, seriously.
And if it's something that completely makes sense, just run it by us. You know, I mean, if it makes sense, then that's what they like.
Well, I think you're going to start to get these because they're out there and people are building them. I know of several. I mean, this is happening, and no one's put them on the market yet, but they're going to. We're going to be interesting really to see how those smaller units are going to sell, because it's just not 3
They say everything comes back in style. I was in one of those years ago. My first house was a single wide. That's what we called them back then.
Right.
Yeah.
Yeah, they weren't called tiny houses.
That's where I started.
Well, you know, they're 300 square feet. We've had Eric Maroney in here, you know, talking about these things. It's just that in order to solve the housing crisis, you have to be creative with it.
We need
let's face it, we need it. And not everybody wants a 3-2 that he loves to loan on. That you guys love to loan on. We have other stuff we need.
And think of 5 years ago, the people that were in the game that could get into a 2-bedroom or an older 3-bedroom of a smaller size. Those people are long since out of the game when the way prices have risen and have gone. So those were kind of the lower end entry level homes, and they're now out of the reach of a lot of young families and people who would like to get into homeownership. So, and they're hard pressed to find a place to rent comfortably and to live comfortably.
Well, and let's face it, if you're renting, you ought to be buying because it's cheaper in the end here, especially with prices and where they are, right?
If you can do it at all, I just ran a quick little number. If you were to buy a $300,000 house,
Okay.
you know, with a little less than 20% down, because everybody doesn't have that.
Yeah.
You know, at the end of 15 years, you're looking at something that's $560,000.
Wow.
You know,
And
that's
built
appreciating
up.
lower than the historical.
Well, at the rents that people the rents that people are paying, the rents that landlords are getting, 37% of Jackson County's renters' income goes to rent.
Yeah.
That is extremely high. The state average is like 24%. So that can continue,
It's
and
unsustainable.
the landlord that's got to stop. They can't do it anyway. You're better off still by buying. Anyway, it's kind of the whole thing comes back to that. Anyway, we're out of time. Philip, nice to meet you. Good luck to you and in Washington Federal. Wish you well. Some great information tonight. I really learned a lot about this today. You can, of course, you can always find Guy Giles. You can Google him, Guy Giles. It's guy.g
At bank34.com.
at bank34.com. He's great. He knows all these things.
If
And
you just shoot an email and just run a scenario by me, I'm happy to answer it that way. Or give me a call.
and you're busy, and that's really a good sign that things are
You'll
still
be
moving
answering
along.
those
I love
emails
it.
about 12 hours a day. Just
we go.
kicking them out. Good work,
We're
guys.
waiting for Guy to go 24 hours a day. No, we're not. We really don't want you to do that, buddy, because you're busy enough. That's going to do it for the Real Estate Show this week. Thanks for joining us. For Pete and Joe, we'll be back next Saturday as well. Another terrific show with you. Hope you'll stay with us. In the meantime, stay cool this weekend and all of that. Enjoy your week, and God bless you all. We'll see you next Saturday right back here on KCMX.